Now, the third step is a big part of it as well. So that's the probabilities, right? So let's talk about trading the probabilities. So when you look at broad markets, they'll tend to, have trends where they'll go up maybe up hard or up down hard, but then you'll see them kind of trading sideways. So a lot of times you'll have maybe 2 to 3 week cycles, and the markets will trade in the sideways channel maybe 78% of the time. Now, based on this sideways price movement, all the out of the money option buyers are going to lose about 70% of the time because those things will come due and they'll expire worthless. So the market makers, the professional money, they know these statistics and therefore want to tend or trade from the sell side. They want to sell that premium that they know is going to go down in value over time based on that theta decay and the implied volatility crush. So this is the professional money, and so we need to think like that, and it all comes down to the math and the math probabilities. So when we're looking at the option market makers and the mathematical market, that's what we're using to give us these probability statistics for price movement of an option into its expiration. So by knowing the probability of your underlying security finishing within a certain range at its expiration, that is really key to determine then what options you want to buy or sell and what option strategy to use. Now, these statistics will forecast how likely it is that an option will fall within this certain range of its option series price range, up or down, by that expiration date. Now, and to forecast this is what we refer to as the implied move or the implied expected move of your stock. And theoretically, the implied move is estimated by kind of a plus or minus 1 standard deviation move over the current cycle of that security. So basically, think about 1 standard deviation as maybe a normal price movement of a stock for that option expiration series, either up or down. So when you're thinking of 1 standard deviation, that's really, basically, what it can actually do as far as a range. So if you've got a 1 standard deviation up or down, that's kind of a normal potential price range for that security based on the day's expiration. So here's a really good graphic example to kind of illustrate this, hopefully more for you. So if we look at out of the money options, so if we're selling out of the money options, that's basically we're selling 1 standard deviation out of the money. So you're going to basically start out with an 84% theoretical probability of that being a winning trade. So for example, when we look at the delta of 1 is equivalent to 100 shares of your security. Now remember, each option contract is equivalent to 100 shares. So that's where the option delta kind of gets its total value. So if we have 100, which is the max value, 100 for a delta, and we were to sell the outside point, let's say right here, that has a 16 delta or 15.9 or 16 delta, that's going to give you an 84% probability of winning. So 100 minus 16 is 84. So if you were to sell this 520 call, you've got an 84% chance that price will be below 520 at its expiration, day's expiration. So this had 5, 10, or whatever, that has an 84% probability. So that's why when we're selling options, a lot of times the different strategies, they're referred to as probability trades. And the same goes with, in this example, if you were to sell this put. So if you sold that 480 put with that delta of 16, that's that outside 1 standard deviation point, that's going to start you out with the probability that price will be below 480, 84% probability of the time. And then to look at this standard deviation, it's just the range between that 480, the outside point, and the 520. So that's, what we're going to play with as far as, taking advantage of these kind of probability statistics to help us set up trades and have a better idea of the probability of those things working out.